How many investment professionals do we have here tonight? Just about everybody, right? So when I go out to visit our clients who are by and large investment professionals, I get two questions. What new data do you have, and what new investment insights do you have? Investing is hard, and so we're looking for any way we can to get an edge. What if I told you that there was a class of signals that's uncorrelated by and large to other signals, that has long horizons, so you don't need to be agile in trading in milliseconds, that is uncorrelated to common investment strategies that investors commonly employ, like value, quality, momentum, and is suitable for investors regardless of your aptitude for taking risk? Would you be interested? Yes. Well, that's what events are. Okay? Events are that type of signal. By definition, they're idiosyncratic. So by and large, they're uncorrelated with other signals. So number one, and then another benefit is very few people are using them. So out of the investment professionals in the room, I always ask this question. I don't get many hands, but it may be different based on this crowd. How many of you are using events either formally or informally somehow in your investment process? Okay, Barry, you don't count. That's a few hands. So there's nobody competing for this alpha either. Okay, so let's talk a little bit real quickly about the nature of events, why aren't people using them, why you should be thinking about them. Okay? So first of all, events are really messy, right? They can be exogenous or endogenous. Arguably, pushing your earnings date is an endogenous event. CEO turnover is an endogenous event. Activists pursuing a company would be exogenous. So they come from different places. The breadth is very narrow, which is a real problem for quants. The data tends to be nonlinear, sometimes tail in nature. If you're a quantitative person, that makes you shudder. Combined with the low breadth, it's a challenge. Okay? Why are they intriguing? Well, they're differentiated ideas that nobody else is using, right? And they're also hard to put into your portfolio. So we could talk a long time about different techniques of transferring a signal into alpha and building portfolios around it. So I know we have one academic in the room, but academic studies event studies typically list out all of the events in a panel of data. Okay, and then you take some grand mean, maybe some standard deviation or t-stat on that mean, and other statistics. And that's supposed to be your average experience. As an investor, that's not what you're likely to get. What we advocate when you're thinking about events is building a portfolio formation or portfolio simulation approach. So rolling through time, rebalancing with some frequency, and then examining what the impact is on your portfolio. Inevitably, that number is much lower in the magnitude of 50% from what you'll be seeing in an academic type panel approach to event studies. So my group is very intrigued by the topic of events. We've looked at a number of them, and in all of the papers, we'll look at the results, Fama-French residualized, show the results in a panel approach, and then the portfolio formation approach with various holding periods. What are some of those strategies? So these are all published papers available on the S&P Capital IQ website. I'll just go through them quickly. Our most recent piece is on lenders lead, owners follow. This is the idea that the markets are in possession of different information or emphasize different information at different times. In other words, there's circular causality between specifically the fixed income and the equity markets. So is there information that the equity guys are keying on, the fixed income guys are keying on that the equity guys should be paying attention to? And is there a lead-lag relationship in that information transfer? The next paper is informative insider trading. So we look at insiders, the legal insiders trading, and corporate insiders, and look at whether intensive buys, CEO buys, changing from sells to buys is a signal for investors. Okay. Another paper we did, very interesting, and this is wherever possible is global work. We looked at the importance of a CEO or CFO departure. And it turns out, I was very skeptical that a CEO mattered, but they do matter. So when a CEO leaves a firm, it can often signal a turnaround. Most CEOs inevitably are fired. The average underperformance in the 1 year prior to a CEO departure in the US is somewhere in the magnitude of an underperformance of 15%. What board can stand that sort of underperformance. Okay? But the new CEO often can affect positive change, and we see those positive changes start to occur in the operating metrics. So you don't even have to guess or forecast which CEOs are going to be effective in engaging in a turnaround. You just wait to watch for it to happen. Okay? We looked at share repurchases. This is different than a lot of the academic studies. We looked at the share repurchase announcement. So just the press release. So they haven't purchased one share. What happens? And what are sort of the dynamics around that event? Are there differences in the type of events? Obviously, larger buybacks are more important. Okay, so some buybacks are smaller and they tend to be anti-dilutive, so the management's been paying themselves and then just wants to offset that dilution. You know, that has no effect. The big, like 10% repurchases are very meaningful, just the announcement. Okay. Probably one of our best ideas is the activist idea. So we look at just a trigger. So whenever you have an event, we think of it as a trigger. So trigger, response. The trigger for an activist is a 13D filing. And so what happens in the subsequent periods, or in other words, the post-event drift or the momentum effect that ensues around a 13D filing and all the media frenzy that often accompanies it. So essentially, this is the only strategy I know of that I can tell you, and by me telling you, it makes it better. Most other strategies sort of get diluted away. This one is just a momentum strategy. And then lastly, we looked at dividend policy changes. And our work, again, focused on the press release, not looking at X date. I'm pretty sure that the market cares about, you know, when the board comes out and makes the announcement, and then the market prices that, not when the dividend's paid. Right? And so our work, that work is global, and it's in line with sort of the academic findings that dividend policy changes would act as you'd expect. Increases or initiations lead to outperformance, cuts or suspensions lead to underperformance. So really what I want to do is draw your attention to the possibilities around events. There are so many different events that can be treated in so many ways, and it's really in the early stages, in my opinion, of harvesting this alpha, because a lot of folks really just aren't focused on it. I think the fundamental guys may have an edge in this area, but they don't really know how to rank order it and how to harvest the alpha effectively. They just usually are operating on an intuition. Just to reiterate, events belong as part of, I believe, every equity investor's process. You can use them as a sort of a check on what your signal already is, or you can use it as a signal itself that's then integrated into your portfolio construction process. By definition, they tend to be idiosyncratic and thereby uncorrelated to other sources of alpha that you're already harvesting in your portfolio. Furthermore, there's very little competition for this alpha because people aren't concentrated on it. So just by the show of hands, and this happens, I've given this talk a number of times, there's very few people at least that will admit that they're using events in their portfolio process. Yeah, thank you.
Any questions?